Welcome back to Switzer on Sky News Money. Markets start off today following a good run this week. Our next guest is here to share his views, and he'll also talk us through a couple of charts. Here's Rudy Philippek van Dijk. Rudy, welcome to the show.
Well, I hope so. I made the whole trip from Manly especially to come here.
Oh, you're a very good man, and you also created some charts for us, which I look forward to discussing with you.
I did actually. And I mean, apart from obviously observing the market and share prices every day, and I mean, I also pay attention to a lot of analysis that's being published here and there.
Yep.
And this week I came across some analysis by Morgan Stanley, and I thought some of those charts they present to their clients.
So we're just going to get them up, so we'll come back to them in a couple of questions' time.
Yes.
We've got some time, so I look forward to talking with you. But in terms of the sell-off that we've seen today, after what's been a good week so far, do you think we've found a bit of a bottom for this correction that we've sort of been having? Mild correction?
I mean, that's almost like, well, what's the weather going to be next week?
You're a smart guy.
Well, smart doesn't always help in this market because there's quite some shenanigans going on in the market.
What are those shenanigans, Rudy?
Well, there's tax loss selling, there's portfolio reshuffling.
In the financial year.
I mean, it's all happening in June. So I actually think we probably get a clearer picture once we move through July, and then the reporting season, which is going to be quite important.
That's sort of what we're really hanging out for in the Australian market now, aren't we? That's the big sort of.
We have to be careful what we wish for. I mean, there have been more profit warnings in May this year than we've seen in a long time. Luckily for us investors, it's predominantly mid and small cap stocks, but nevertheless, I mean, it shows you that the dynamics in Australia obviously are not that necessarily conducive for shareholders, to say the least.
Yeah.
But I do think that we shouldn't be spooked by today's sell-off. It's probably more related to the fact that there's a lot of futures trading going on today. There's expiry of futures, and that always has a big impact on the market. Today, the volumes were enormous, and they were very large in the first half hour of trade.
Yeah. Which started off early, didn't we?
Which means obviously it was all happening in the futures market. And I would have expected that the rally early in the week would have taken the futures market by surprise. They had to reset that today. I mean, those day-to-day shenanigans, I would assume that most people have a longer-term view, although admittedly we all make decisions on very short-term impacts. And I would actually think that today's sell-off, in particular in the stocks I follow, if they're sold off today, because not many of them.
Buying opportunity?
I would definitely throw some extra money there, yeah, because you probably won't see those share prices back anytime soon.
Yeah. So, Rudy, these charts we've got the first chart about to come up on the screen, so we're just waiting for that.
Okay.
So it won't be far away. But anyway, before we talk about that, though, where do you see the growth coming in Australia at the moment? Do you think it's the offshore earners?
Well, that's more complicated in Australia, and that's why I thought those charts were quite interesting. We'll see them in a minute, but I mean, the reason why a lot of strategists and economists globally are quite positive on equities for the year ahead is because there is definitely a pickup, and it seems to be synchronous across the Chinas, the Europes, the North Americas of this world.
We'll come back to that. We've got this first chart here, so now it's up. Let's get into it.
And that is that's the third one. Okay, well that's the Australian dynamic.
Can we go 3, 2, 1? Can that work?
We can do 3, 2, 1. I can just change my.
Lance Lai, our regular chartist, if he saw that happen on screen, that would really throw him out. But
well, here's the point. This shows you that the wage income in Australia is at its lowest point in, well, it says ever, but very low. So this is the challenge for the Australian economy.
Okay, so we're saying, what is it? So the wage share of income drops to its equal lowest level since when?
1964.
1964.
So there you go. So that's the challenge for the Australian economy, and that's why I said earlier that all that positivism you'll find among strategists in the UK, in Europe, in the US, you won't find that necessarily in Australia, because we have this as a problem. Plus the fact, of course, that our local economy is not firing on all cylinders. That's putting it mildly. And we have this big challenge now with consumer spending and housing downturn and etc.
What's the good
and
news?
commodity prices are not firing either. Right?
No.
Well, the good news is, if we go to the other charts.
Okay. Chart 2 or chart 1? Wherever they come?
It doesn't matter. I'll adapt.
You're agile.
I'll adapt.
Excellent. So we'll get the next chart up on screen.
Okay. Well, one of them should be about profit growth in the US. And there it is.
Okay.
It's the profit growth in the US.
From Morgan Stanley?
See what Morgan Stanley has done. They've developed their own indicator,
Okay.
which is forward-looking, and which shows you where, all else being equal, profit growth, corporate profit growth in the US should be in the months ahead. And according to their indicator, which you see on that yellow line there, profit growth is on a strong uptrend now in the US. Now, traditionally, we can all start worrying and talking about Brexit and North Korea and China and whatever, but ultimately it all comes down to profit growth. And if profit growth is as strong as their leading indicator indicates, that means investors should not worry too much about what's happening in the share market today in the US and one day down and etc. Because even with a Federal Reserve that is on rating, hiking rates,
Yep.
if profit growth is that strong, the share market will be higher by year.
Yeah.
That's basically the
And the fact that they're hiking rates is a positive because the economy
yes.
should be getting better. So that does support your argument.
Well, yes, but you know what happened in January 2016? They were hiking, and it was the wrong time to hike. But if leading indicator developed by Morgan Stanley is correct,
Yeah.
then investors shouldn't fret too much in U.S. equities.
Okay. Even though the US is at an all-time high right now.
Exactly, and that would be the next chart.
That could be an all-weather performer, couldn't it?
Indicate
Based on that chart.
that's not too much of a worry either.
Okay.
Because that whole argument that you see sometimes those really scary charts, and I mean, on some valuation metrics.
So what we're looking at here.
We're looking at here at the yellow line is what Morgan Stanley's model, which is different from most models because this model also takes into account interest rates, bond yields. And what this model shows is that the yellow line is where the intrinsic value of the US share market is. And the blue line is where the market actually is, in effect. And you see that we're now going through a period where the US market, even though it looks bloated and elevated, it's actually below intrinsic value. Okay. I mean, and see, Morgan Stanley strategists believe that the actual market will catch up. So the blue will catch up with the yellow line, which means there's a lot of upside happening. See, I'm not so sure where that's going to happen, but even if that doesn't happen, it indicates at the very least that the market is not necessarily overvalued. Okay. And I think that's a positive too.
And that would be good for our market, hopefully, of getting back to its all-time high if the US can go overs, and maybe we can get dragged with it.
All-time. Well, that's basically the scenario which we've seen over the past few years.
And we've been waiting for it for a while, haven't we?
People always think I'm negative when I say that, but it's actually not true. I mean, the US is in a bull market, and we're just sort of getting dragged along with it, but it's their bull market in the first place, and that's why we can't keep up, and that's why you see those dynamics are different. And the best thing we have to hope for as equity investors is that they keep on going, and then we get some too, I think.
Yeah. So you mentioned before that some of the companies that you owned, if they've been sold off, there could be a good buying opportunity. Yes. What are some of those companies?
Well, here's an interesting one. I mean, this is a Goldman Sachs survey. They published that a few days ago. They looked at, because investors always get interested. Share price falls, we get interested, yeah? But there's a difference between sometimes it's justified and sometimes it's not justified. It's a very simplistic form. Now, they've done a lot of data analysis and went back a lot of years in the past and stuff. And on their calculations, 60% of the stocks that falls is justified. That means 40% isn't. Eh? That means the opportunities are in the 40%, not in the 60%. Now, in the current context, they've done a survey which are justified, which ones aren't. What I found remarkable is that in their group of stocks which they came up with, which tend to be not justified, a lot of retailers are in there. Okay. Right? So I thought that was a standout. You think about the likes of JB Hi-Fi, Super Retail, Green Cross, even Bank of Queensland was in there. But amongst the stocks that are justified, you will find the likes of Main Pharma, also two banks, Westpac, ANZ, interesting. Flexi Group was in there, SG Health. So Vocus was in there. So you see a lot of those stocks that haven't performed. Essentia was in there, by the way. So you see they've come off, they've bounced a little bit, but if Goldman Sachs' research is correct, then they should still not be a good investment for the longer run. To answer your question directly, I own Bapcor in that retail group. Which
one?
Bapcor,
okay.
BAP.
Yep.
Yeah, I don't think it's a retailer. It's not a retailer, but it's put in the same basket. And I've seldom seen analysts making such a big case of this stock is really unfairly sold down. And can only assume that at some point the market will catch up to that fact. And maybe what we need to wait for is the August results.
Yeah.
And in the meantime, I'm actually buying extra shares, so I'm definitely keeping my fingers crossed for August.
Are you concerned about Amazon for retail stocks?
Not for the likes of Bapcor. For some retailers, yes. And I recently saw the CEO of JB Hi-Fi give a presentation. He believes that the strong connection they have with their customers will sort of insulate them from the Amazon effect. That is probably partially true, and I think that bricks and mortar retailers will have to have that or develop that or have to have some reason why you would go to their shops. If there's no reason other than price, I think they will have a very tough task in matching Amazon on price.
Yeah. Deliver value in other ways is what you're saying.
So exactly, they will have to find ways, and it goes without saying, not every retailer will be able to do so. I mean, will JB Hi-Fi be able to do so? Well, they're probably amongst the better ones placed, I think. And the fact that they're closer to $20 than above 30, that probably adds to the. But apart from Amazon, I still believe that the retailers' sell-off has more to do with the fact that we are worried now, rightfully so, I think, about consumer spending, which is a whole different challenge, and Amazon hasn't even arrived yet. So I'm not a big fan of owning retailers in general, because there's multiple challenges there, and I do believe that the current share price, even though Goldman Sachs says it isn't, I actually think in a lot of cases it probably is justified and it won't bounce anytime soon.
Rudy, thanks for your time.
My pleasure.